I'm Chris Preston.
Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Coming to you live from the Madison Avenue studios, as always. Um, Brad, it is March, and it's this is my favorite week of the year on the sports calendar, at least. March Madness opening rounds. I know you refused to do a bracket this year, which means yeah, it's a mistake. You would have won if you'd done it. The less you know, but anyone who always says I don't know anything, I'm not doing a bracket this year is a mistake because the less you know, the better you do. I love college basketball is my favorite sport. I've been running a bracket for 20 years and have never won the thing. My wife has once
Oh
and
yeah.
is always in the running. Usually it does better than me. So, did you watch any first day or are you totally tuned out?
No, I watched some the first day. I haven't watched enough college basketball to have an informed opinion. I probably would have had Clemson going to like the Sweet 16 or something. How far did you have Clemson going?
I had McNeese beating them.
Did you
How about
really?
that? Yeah. I had both upsets yesterday. I had Drake beating, they beat Missouri, and I had McNeese winning. I did miss four. I bet against Calipari. I had Kansas over Arkansas, but yeah. So maybe this is the year for me. We'll
Yeah,
see.
maybe.
My team's
Like
not in it, so maybe that helps. It clears out some of the clutter in there. Your team, you're
four
Arizona.
seed.
They play today, right? Later today.
Yeah, they play.
Yep. Yep.
I don't love their chances. I figure it's 4-13, so they probably walk, but I'm not super optimistic. The problem with at my age, having watched decades of college basketball, but not having followed it this year, is like any of my picks are going to be based on legacy. Be
Hmm.
like, oh yeah, I like you know, Michigan State over the years, right? Or like the teams that have been like outperformers that have been fun tourney teams to watch. I would have overweighted them and probably underweighted the actual talent. But I heard Obama went straight chalk this year,
He goes
so
chalk every year. Every year. Yeah. He I think at least now it's not there aren't certain states where it's like probably politically motivated. Like, he'd choose like anytime there was a swing state
Houston's winning it
school.
all.
Well, anytime there was a swing state school that, he wanted, like North Carolina, he picked them every year.
Yeah.
Or, trying to think of another, like if Ohio State was involved or something like that, Michigan.
I did see just while we're closing out on the topic, Robinhood now has futures contracts on the outcome of basketball games.
Really?
You can now bet sports on the Robinhood investing app.
Wow. Wow.
It's
I'll
just
check that out.
it's inescapable these days.
It's everywhere. I mean, yeah, that's why I'm still pretty high on both DraftKings and Flutter as stock picks. I think it's supposed to be a record amount of betting this I can't remember if it was this month, this weekend. So yeah, fun week, whether you're betting or not. Okay, let's move on to investing. Tell people what we're going to talk about today.
All right, this week we are going to do starting five, talk about the Fed meeting. We are going to talk about market movement for, I don't know, this year so far, a little bit about the market's response to the Fed as well. We are going to talk about the Magnificent Seven turning into the Lag Seven, so Mag Seven to Lag Seven. Been a tough year for big tech. We will talk about overseas investing, especially the Eurozone. And then we are going to wrap it up with a conversation about value stocks, which are outperforming right now. But before we get started, Chris, you are about to be on the clock. This week, your take to defend the market bottom has been put in for the first half of the year. You have 90 seconds and you may begin.
Yes, so a lot of sort of data has been encouraging. So first of all, this, it's not as we're not in as quite as grim a place as we were last week when we had, Mike and Jacob and Michael Brush on, where stocks just been falling for three straight weeks. They're basically steady this week. They did we are up from the bottom, which was, I believe, last Friday. But now I'm going to borrow something. This is something you wrote about earlier in this week. You got this data from Fundstrat, that this is the fifth fastest correction in the S&P in the last 75 years. And the other four that were faster, and I think two that were either tied or right, just right
Yep.
behind it, um, all resulted in stock prices being higher 3 months, 6 months, 12 months out, and 1 month out, with the only exception of the COVID retreat. That was, a bear market retreat in March 2020. And that, of course, prices were way higher down the road. Uh, and so that's one thing. On the New York Stock Exchange, number of highs has now exceeded 52-week highs has now exceeded the number of new lows on there for the first time all month. The new number of new lows is now below 40, which is sort of a number that Mike Santolo has flagged as an indicator. When number of new 52-week lows is below 40 on the New York Stock Exchange, that's a good sign. Sentiment has been incredibly
Time.
negative. It's 0.8. I think is that an investor sentiment stat? I can't remember what that is. That Michael Brush had flagged for us. It's everything is pointing towards stock prices being higher in the coming months. So I think we've already hit a bottom.
Yeah, I think the investor intelligence I think was zero point 0.8. The
Yes, that's right.
AAII was like zero point 0.3. It was the
Mhm.
lowest it's been in a really long time. Sentiment is definitely beat up. Um, I mean, we this week I think is the first week in the last four where the S&P is maybe on track to close positive.
Yeah, I think
So
as of like an hour ago, with the way stocks were down, we were down like 0.3 for the week, 0.3%. So that would have been 5 straight weeks of negative returns for the first time since 2022, which is not a good thing to be compared to. But we'll see how stocks finish up the day.
you know what we need to do? This is just related to the defend the take. Like a 10-second warning. I think we do that. Just be like
Yeah.
just 10 seconds and then you can keep going. But
These end up going like usually 105 seconds is,
yeah.
so 10, 15 seconds too long. But anyway, that's my take. I was tempted to go with, yeah, bottom for the year, but there's just too much uncertainty. Who knows what's going to be happening with tariffs, inflation, everything in the back half of the
Yeah.
year. But I feel pretty,
Well,
markets forward looking about 6 months at least out. So I feel pretty confident saying that it's bottom for the first half of the year.
yeah, I think it's a reasonable take. Like we're probably oversold right now, at least in the near term. But
Yep.
uncertainty is kind of the name of the game. And we saw that with the Fed, and we saw that, I'm sure we'll get more into it, but everybody is just sort of apprehensive and looking around and wondering maybe what's in store. So yeah, there's a case to be made that this was it and that we just continue the bull run. And it's like money supply is still really high. The Fed put
Yeah.
looks to be in effect. So there's like a lot of things that are like structurally bullish, but there's just weak sentiment and uncertainty, and it's really tough to make a call more than
Yeah.
anything.
And fifth fastest, that's easy to say, in the last 75 years, that's not nothing. Fifth fastest correction in the last 75 years. I mean, we're 10% in what was it, 15 trading days, I think it was.
It's
Something like
like
that.
it was within 20 calendar days. I
Yeah.
think it was like 18 trading days. I don't. So the what you're referring to was in the daily a couple of days ago. It was from Fundstrat. They they did a there was Tom Lee, who's their head of research, did a video on it, but he was conflating trading in calendar days. So within 20 calendar days was the
Yeah.
actual marker. The problem is like it's small sample size. The fastest, or I believe the fastest was COVID.
Yes.
And then you had Eisenhower's heart attack. You had the start of the Korean War was in there. So things that were like materially different markets. There was the Fed put the federal balance sheet building and immediate like emergency rate cut measures have only been around for the last 17 years,
Yeah.
really.
Well,
So
late 2018, China trade war was in there too. So
yeah.
that's a parallel.
Yeah, and I think that's probably the best one.
Yeah.
Which is still it still sort of sets a bullish tone, but it's just a little bit less rosy than I think the fund strat piece conveyed. That
Yeah.
was my takeaway, at least, is like I don't think we're 20% higher 6 months from now. Are we
No.
10% higher? Yeah, maybe.
Yeah. Yeah. And that would be my guess. Yeah. 6 months, I feel good about saying that. Beyond that, I don't know. Okay, let's get to our starting five today. Yeah, we're no guests today, so we're expanding our usual big three to a starting five. Fed talked this week, and they didn't say anything that derailed the market. Market mostly liked that Fed seemed to be holding their on their dot plot at least two rate cuts projected, two 25 basis point rate cuts projected for the back half of this year. Um, there's some comments, and the one comment that stood out to people and made some headlines was
Mandatory.
transitory, which
Yeah.
is that's PTSD for anyone who, the last time the Fed said there's going to be transitory inflation was 2021, 22, and we're still in that transitory
Yeah.
period. Uh,
Kudos to Craig Torres of Bloomberg for calling that out.
yeah,
Because I heard the word and I clocked it, and then he immediately asked the question, like, well, you said it was transitory last time. So,
yeah,
um, we're not the only ones hearing it. I think anybody that's been paying close enough attention to tune into the presser probably clocked it.
yeah,
Couple of like notes from the meeting as far as expectations go, their median rate path, so what the sort of middle of the road expectation is for the group as a whole, is unchanged, but their outliers had shifted higher. So it seems like the Fed is more open to the prospect of rates staying higher, or at least individual Fed members are. The gauges of uncertainty are all higher. I think that's going to be like the name of the game this week is uncertainty. They did raise expectations for PCE to 2.7% this year. So PCE inflation from 2.5. Core PCE was 2.8 from 2.5. Unemployment expectations ticked higher from 4.3 to 4.4. And they anticipate GDP growth is going to go down from 2.1% this year to 1.7.
yeah.
The the big thing is the Fed is responding to economic data that they have already received, which is pre-implementation of tariffs.
Right.
And Powell was, he wasn't totally clear, but he acknowledged at least that any kind of inflation pressures that they're seeing now are anticipatory. And where that is a concern for me is that the Fed is reacting to effectively how seriously others, specifically business owners that are maybe ordering in advance or raising prices in anticipation of tariffs, how seriously they are taking the threat of tariffs. So this is not Fed as like independent oversight board coming in and making a judgment call. This is them just reflecting expectations that already exist in the marketplace.
Yeah.
So I do think that there's a risk, and who knows what's going to happen, but there is a risk that the Fed looks like they got caught off sides because they're doing what they always do, which is responding to data and responding to what they're seeing versus responding to what they may feel the likely
Words.
outcome is. Yeah.
Yeah. Yeah. Words are what they meant. Yeah. Um, yeah, I think the market, I think, focused on them maintaining two rate cuts. It thankfully ignored the transitory comment other than to point it out, but the market didn't implode because he said that. And even his more him saying that inflation is likely to be a little higher, that growth is likely to be a little slower. I think that was already priced in. I think
Yeah.
it's people already knew it. I think if he had gone into, something more extreme or, a bit more panic mode, that would have really sent a market that was already hurting maybe lower. So this wasn't, he didn't, do anything to upset things or say anything that people didn't kind of already know at this point. So in a way, he was almost may have almost had a bit of a calming effect. The fact that they're going off of the data that's in front of them so far, rather than all the Trump and tariff related noise.
Yeah, there was an additional positive in there. They slowed the rate of their roll off of T-bills from 25 trillion, or I'm sorry, 25 billion a month to 5 billion a month,
Hmm.
um, starting in April. So they are allowing their balance sheet to not slow as quick. It's not quite building it up again, like they're going out and buying assets, but they have that is a signal that there is some degree of Fed put in play, right?
Hmm.
Where they are going to be able to respond, or they at least want to be able to respond in the event that inflation ticks higher or market conditions deteriorate. Um, where that, potentially leaves them is if inflation does come like roaring back, they may just be constrained from cutting rates. They might not be able to do it. Trump, I think, came out after the meeting and said the Fed should be cutting rates already so that tariffs can ease into the economy, but that's not how rate cuts work or how tariffs work. So I,
No.
I don't I don't know how beholden they're apolitical ostensibly. I don't think they're going to be beholden to calls to cut rates. I think they're going to be constrained by the data that they see. But the fact that they're slowing the pace of balance sheet roll-offs for treasuries does tell me that they want to be the market's friend.
Right. Yeah, and for this week they sort of were. At least they weren't faux this
Yeah.
week. So at least not the foe that, say tariffs have been. Um, okay, so let's get to the market. We can just briefly touch on the market. Since I talked a lot about it in my defend the take. Market is basically flat for the week, but it is S&P is above its low, which was last Thursday, 55, at least closing low, 55.21. We're now at 56.29. Um, yeah, I don't know. Like I said, I think prices are going to go higher in the coming months. How quickly that happens, I don't know. There might be sort of a bottoming process here. That this is, Mike loves to see sort of a basing process, as he calls it, and that's kind of what we're seeing here with things flat basically this week. Stocks are down a bit today, but I don't think it's going to be a straight line anywhere for,
Yeah.
maybe another week or two at least. It probably needs a catalyst. I don't, maybe the catalyst will be the start of
Mm,
next earnings season, maybe. Uh,
or or no tariffs in
or no
April
tariffs.
or like
Yes.
that.
Yeah.
That's,
April basically will be the catalyst. That's when catalysts will start to come in, I think.
yeah. Yeah, I like right now the broader markets are just all sort of rattling around below their 200-day levels, but they're off their lows. The one thing I was telling you before we started recording, the Russell 2000 marked a death cross where its 50-day moving average crossed below its 200-day. Um, you know, it's called death cross for a reason. Typically it's bad news. We saw that happen at the beginning of 2022 for the Russell,
Mhm.
but we also saw it happen twice in 2023. Um, the like my big picture view on it is that we are going risk off or at least risk down, but maybe not all the way risk off. The the Russell's down over 7% this year, Nasdaq's down over 8%, Bitcoin's down 10%. Like all the high risk, high flyer stuff that would signal a risk on environment has pared back. Could we be going through a repeat of 2022's bear market? Yes. We could also be in the fall of 2023 where we saw a correction and then stabilized and bounced back. And like the money supply is bullish. Money has to go somewhere.
Yeah.
Like that is part of why growth stocks and tech stocks and AI were flying the last couple of years is there is a ton of money sloshing around that has to find a return.
Hmm.
We've talked about like money market fund balances going up, but a lot of it was flowing to equities, and now a lot of it is flowing, as we'll talk about later, to Europe. So the money's gonna go somewhere. It's just a matter of where it goes. I don't think it's all coming out of the market. So that is going to buoy
Yeah.
overall performance. Um, Absent like really terrible news, I don't think everybody just goes entirely to the sidelines like across asset classes where everybody's just parked in cash. I think you end up just maintaining some higher valuations and you get underperformance over an intermediate term period instead of like significant losses. So
Yeah.
even if we are in the beginning of 22 era, I don't know, maybe we fall another 10%, we just barely hit like a bear market. Like it's not end of the world. COVID was as close to end of the world as we got, and even then,
Lasted 6 weeks that the crash did, basically.
yeah, and then the money hose turned on and everything rebounded. And the money
Yep.
hose, the puddle from the money hose is still there. The money hose
Yeah.
isn't quite on yet, but the money is still out there. So it's
Right.
gonna go somewhere. It's just a matter of identifying where.
Yeah, and I think the case for going into equities, bond yields are still lower than they were, amidst all this tariff and inflation fear of the last few weeks. Bonds have stayed in sort of the 4.2, this 10-year bond, treasury, stayed in the sort of the 4.2 to 4.3% range, which is a far cry, or, you know, a meaningful cry from when it was in the 4.75, 4.8, nearing 5%. So I think that's, and then, now that the Fed reiterating that they're going to cut, 50 more basis points later this year is probably helping that narrative. So I think that's, sort of making the case not only for money finding a home, not just in cash or bonds, but potentially in equities, especially after a 10% correction.
Yeah, I like bonds if the Fed starts like panic cutting rates. If it's like foam the runway, save the economy, start cutting rates. I think bonds are really attractive right here. But for the time being, it's cash is pretty appealing. Um, yeah, I don't know. Everybody needs to just relax a little bit. Not the end of the world.
Yeah, I think that's what we're going to get. What we got this week, we're going to get maybe for another week or two until what is the deadline on the tariff thing? It's like the first week of
April,
April.
well, it's April 2, but it's April 2 until somebody sends a mean tweet and then it's May. Like
Right.
it's the unpredictability is the really tough thing there. Although I
Yes.
did see that I don't know if this is out and maybe you can illuminate this a little bit. Maybe not. But apparently we as a country are going to be sending a list of demands to all the countries that are potentially subject to tariffs, where if they meet our demands, we won't impose tariffs.
Right.
That does go to the tariff as bargaining chip
Yeah.
narrative a little bit. Like at some point, you just walk away from somebody that's not an honest broker, and you say, "All right, I'm just not going to mess with this anymore." And I think we're there to some degree, but
Yeah.
we're a big consuming nation that buys a lot of stuff. So if the demands aren't too onerous, maybe you come back to the negotiating table. I don't know.
Yeah. So I think between that and then earnings season starting, what, a week or 10 days after that, I think we'll see some movement. Again, I think it'll be upward in the next month, maybe less than that, maybe 3 weeks, but I could see things holding firm for the next week at least, if week to 10 days, that type of thing. Okay, let's move on. Number three, Mag 7, they famously carried the market. There was no term as the Magnificent Seven prior to this bull market. And there was a Tesla, Google, Apple, Amazon, Nvidia. It's two more. Microsoft, sixth one. Meta, Meta.
Got it.
And Netflix feels like one, but it's some reason not allowed at the party. But um, they reverse course this year. Magnificent Seven are now being derided as the Mag Seven now being derided as the Lag Seven, down 15.5% year to date. And this is a really good stat that they were responsible for 95% of the S&P 500's decline so far this year. I think this is through the end of last week. Um, Whereas, before they're, during the first couple of years of this bull market, um, they were up an average of 307%, and they collectively accounted for roughly 30% of the market's gains during that time. So, they carried the market. Now they're having the reverse effect. The rest of the market, and we'll get to, certain pockets that are doing okay, like value stocks in a bit, um, have sort of picked up the slack a little bit. But the market is obviously feeling the Mag 7 lagging. And I guess I wrote what I wrote about earlier this week is, does that make any of the Mag 7 buys right now? And if so, which ones? I'll let you start because I wrote about the ones I like. Would you buy any of the Mag 7 turn lag 7 at these prices?
Well, I mentioned Meta a couple of months ago. They're of the Mag 7 year to date, they're down 1.7% as of yesterday's close. They're holding up the best. Apple down almost 13%, Google down 13%,
Hmm.
Microsoft's down 8, Amazon's down 12, Nvidia's down 14, Tesla's down 38%. The problem with the Mag 7 just conceptually is like as a thematic trade, being highly liquid and doing really well and having big market caps is not really an investable theme. So there was always this disconnect between like the Mag 7 narrative and what I would consider like a serious analysis of equity markets.
Yep.
Um, if I had to, so that's to say that it's not like I can be like I can piggyback on some sort of theme with it and say, oh no, this actually makes a lot of sense. It should be carrying this overvaluation. If I had to pick one, it's Meta still. That's banking on what I see as developments in how the AI trade plays out. But it gets back to the rotation that we're seeing in the markets where it's like, look, it very much feels like they had their run, and I think investors are probably going to be lukewarm on them at best. I don't know what possible catalyst comes out that makes them screaming buys at these levels. The valuations were so high that even with the haircuts they've taken, I don't think any of them are really trading at a discount. Uh, I still like Apple because they have a ton of cash on hand and they haven't jacked up their capex spending for AI, but I did see they lost $1 billion on Apple TV. So like they are sort of a struggling consumer tech company in an economy that's getting a little bit
Even
tougher for
with Severance,
consumers.
wow. I guess that's before Severance started airing. Sorry, go ahead.
No, because like, oh, you mean like
Apple TV
year to date,
revenue
like year
down.
to date. Okay, I gotcha.
Yeah, yeah.
I thought
I
you
think
because
that
like
just
Severance is
started
in.
like a month or two ago, right? A couple
Yeah,
months.
we have Apple TV. I don't use it. But yeah, this so they're like a struggling consumer tech. Google is an everything internet machine. Amazon is Amazon Web Services plus a shoe store, right? Like there's all these sort of tough comps just year over year for all of these companies. I think I can make a bull case most clearly for Meta and for Apple, ton of cash on hand. They're going to weather the storm pretty well, but the thing that has me most concerned is that TD Cowen reported last week that is canceling some of their data center uh, contracts. I think it was in the aggregate something like the equivalent of two data centers worth of contract cuts that they had done. So if we brought this up in the pod a couple of weeks ago, um, if they come out and start saying, "Hey, the economy's tough, we're actually going to pull back on capital spending," I think that's bad for everybody that's connected to the AI trade. That's bad for Meta. It's bad for Amazon, Microsoft, Google. Definitely bad for Nvidia. So that's sort of the sword of Damocles over there. But if I'm picking one, long story short, Meta.
I like that we're on that we have different picks. What I had written this week, I didn't really single out one in particular, but Nvidia I still like just because it's just very simply the fastest growing of the bunch by far, 50% EPS growth, 56% revenue growth expected this year, and it's fallen the furthest, 23% off its January highs. Um, they just unveiled something called the Blackwell Ultra AI chip, next generation semiconductor that offers 1.5 times the performance and 50-fold increase in data center revenue opportunity versus existing Hopper chip. I don't know. The Wall Street might be sort of numb to that. Any new chips at this point, because the AI story has gotten a bit stale, but just going by the growth versus how far it's fallen. I like the upside there. Um, you know, uh, Google, Alphabet, it's the cheapest, trading at less than 19 times earnings estimates. Not growing as fast as like 11%, 12% EPS growth, 11% sales growth expected. And it's just, pretty diversified. Eh, yeah, I think that's sort of the most sort of pure value-ish pick. But I do think, sort of by definition, all of these stocks, and maybe Nvidia was the last of them in the last couple of years, given it, its incredible growth the last couple of years. They've all experienced their greatest period of growth, all of them, which is why they've gotten to the position they are in. They're never going to grow the way they have the last couple of years. If you bought any one of them and held on to it for the next 3 to 5 years, you'd make money. Would you beat the market? Maybe, probably. Probably I would guess probably would with a majority of the seven, maybe not all. Um, but if you're looking for new leadership, what's going to lead us out of this correction? It's not going to be the Mag 7. I guess that would be my sort of takeaway.
Yeah, I would agree with that. They're not going to become the new leaders.
There's no
The,
Nvidia. Like Nvidia was still there's the AI catalyst and Nvidia was, leading the charge and it had been sort of out of the spotlight until a couple of years ago, until this bull market started. Now it's the household name of these seven stocks.
so there's two things just to put a pin in the Mag 7 chat or Lag 7 chat. Nobody is making money from AI yet, except for the people selling picks and shovels. That like there's no rollout to like the business community or to users that is actually generating revenue for anybody. OpenAI lost 5 billion last year. They spent $8 billion to lose five. Microsoft doesn't split out their revenues from AI. They just lump it in with cloud compute. So for the time being, nobody's making any money there. And then I don't, if you remember the Japanese carry trade when that was in the
Yeah,
headlines earlier this year,
July, August.
um,
Yeah.
that doesn't sound, maybe that's right. I don't remember. I don't know. Anyway,
You're
so
thinking of a DeepSeek or Japanese carry trade?
the carry trade, yeah, carry trade. No,
Yeah.
that sounds about right. Oh yeah, because that was the August sell off. That was the August
Yeah.
correction.
Yeah.
Yeah. So when that started unwinding, the names that took the hit were the Mag 7, and that's partially because of that money puddle that I was talking about earlier, because from a technical standpoint, if you're borrowing money cheap from Japan and you may have to call that money back somehow, you need to funnel it into something that is super liquid and that has a big market cap so it can just absorb the money flowing into it. So I think that there's an element to the entire AI trade that was institutional money, hedge funds, big money, just piggybacking on the narrative as a way to park all that excess capital somewhere that was growing. Um, so I mean, I don't know if that there's an actionable takeaway from that other than they're going to have to put liquidity somewhere. So maybe that translates to whatever the next narrative, whatever the next leader is, exploding higher. Or maybe it does translate to some of these bouncing back harder than they would seem to support from a fundamental standpoint. Um, anyway, I don't know. I don't want to write them off because they are big,
Yeah.
they are liquid, and they are natural landing spots for excess capital. But I think for most investors, the move is you've already got exposure through whatever ETFs you have. You already have tech stocks. Look for the clear leaders elsewhere. I think
Yeah.
the odds favor that your next leaders are not going to come from this group.
Yeah. They've been the leaders for 2+ years or were up till basically this year, end of last year. And I don't think I think that was their moment.
Yeah.
I don't think in terms of being leaders, they'll still carry a lot of weight, obviously. I mean, the fact that they've accounted for 95% of the market's pullback this year says just how much influence, maybe too much influence that they have. Um, but yeah, if you're looking for the best outperformers of the next 2 years or whatever, I think it's best to probably look elsewhere. Speaking of which, European stocks have outperformed this year. S&P U.S. stocks are down 4.5% year to date. S&P is at least. Stocks Europe 600 up more than 7% year to date. The DAX, the German index, up 14, 15%. France's uh,
CAC
CAC up.
40.
What's that?
CAC 40.
CAC 40. Up 9.5%. A lot of, there's reasons that money's flowing to Europe, U.S. uncertainty, potential for higher inflation growth, but also just high interest rates. Interest rates are still in the 4.25 to 4.5% range, whereas the euro zone is already below that and set to cut more this year. And I think Bank of England is right around the same level, but also expected to cut faster this year than the Fed. So lower interest rates, while their European growth still isn't expected to be higher than the US's, at least yet, um, this year. European stocks underperformed for years compared to US stocks. And here's Carl Delfeld, who runs our Cabot Explorer um, advisory, sort of our global stocks advisory, wrote earlier this week. This is a great one. Um, so Warren Buffett just invested, this is in Europe, but invested in a bunch of Japanese companies, and the fact that Buffett is looking overseas is telling. Um, America's share of the global equity indexes is around 70%, and that's with a global population of 4% and a share of global GDP of 23%. Share of global trade is less than 15% and has declined over the last decade. So, as Carl's been writing about this for months, that there may be sort of a global rebalancing in that U.S. stocks have probably close to peaked in terms of their share of the global equity market. And it seems like we're seeing that now. I think the whole tariff thing and inflation uncertainty has maybe accelerated the shift to other markets, including Europe and China. That's sort of a separate thing because it comes with way more uncertainties, but that's the Hang Seng is
Thanks.
up 23% year to date. I'll hand it over to you now, but you're basically overseas. We're seeing money. You're talking about where is money going to go? Some of it, at least, is going overseas right now.
Yeah. And I think Europe is sort of this leg of the bull runs Mag 7. I think talking about excess money flows, I think Europe, um, all the credit in the world to Carl on this. He
Yeah.
has been writing about and talking about the prospects of what he has called the great rebalancing for a long time. He correctly identified that global investment was over allocated to the US and it made sense. We had a ton of growth, right? That money is going somewhere. And he's been saying, hey, look, Europe historically undervalued. He's been picking some solid names over there. And he's right, 100%. So, like, absolute, all the credit to Carl on this. I think it continues. Where it's maybe challenging for individual investors is picking names. You and I had talked
Yep.
before recording about this a little bit, and I'm like, I was looking at some German stocks because I like Germany for two reasons right now. One is they're 24.3% of the Eurozone GDP. Um, France ranks second at 16.4, right? There's 37 Eurozone countries, but most of the GDP is weighted to Germany, France, and then Italy is third. The big thing that I like about Germany is that they just rolled out plans for a spending boost, talked about 500 billion euros or about $560 million infrastructure fund. And they also are voting to remove borrowing caps for defense spending. The end result is that it's expected that they'll spend somewhere in the neighborhood of $1 trillion, or that they'll incur an additional sort of $1 trillion of spending. So part of that'll be like debt funded. But that, as we have seen in the US for the past 17 years at this point, that debt funding ends up in the hands of the private sector and ends up reflected in market cap of companies. So I really like Germany, but one company that I was looking at was it's called Heidelberg. It's a German building materials firm, and they only trade like 3,000 shares a day in the US. Um, for institutional investors, you can go to the domicile exchange and buy stuff directly. But I think for individual investors, the way to play it is ETFs. It's going to best meet liquidity needs. It'll be the easiest to get into and get out of. So I think it's going to be tough, a little bit tough to pick winners and losers unless you have a high degree of familiarity or expertise with the sort of destination markets. So I'm overweighting Europe through ETFs versus trying to pick individual stocks there. I know, right? If you want individual stocks, look at Carl. He called it before it happened. It's playing out as he expected. That's the kind of guidance that I would be looking for if I'm looking for individual names.
Yeah.
And
Yeah, sorry.
sorry.
You want to finish up?
Oh yeah, just that excess money floating in the system. It's got to go somewhere, and Europe looks like the destination, which means we could have there could be a lot of runway for this. So you look at it, the DAX as of yesterday's close was up like 14.8%. We're talking about 20 years of relative underperformance for European stocks. This could have a lot of legs left in it, or a lot of runway ahead of it still.
And because he was early on this trend, Carl Delfeld, he's shifted his portfolio, Cabot Explorer portfolio, more heavily overseas. It's a global portfolio. There's U.S. stocks in there. I'd say there up until late last year, there probably were more U.S. stocks in there than overseas stocks, and I think that's shifted. He just recommended a Japanese stock a couple weeks ago, but he's also has some European exposure, and as a result, his portfolio is up 15, more than 15% year to date. Again, that's versus a 4.5% decline in the S&P. If you want to know the names of his stocks in Cabot Explorer, we're offering a chance to subscribe to Cabot Explorer today for 70% off the normal price. If you go to cabotwealth.com/street, that's cabotwealth.com/street. It's 70% off the normal price, $597 for the year. 30-day back or 100% money back guarantee if you want to try it out for 30 days, see if you like it. If not, you get your money back. But as for new subscribers, I highly recommend it. Again, he's at a time when the market's really struggling, U.S. stocks are really struggling. His portfolio is up more than 15% year to date. And what you get is weekly issues and updates. He adds usually two stocks a month to the portfolio. He's got a portfolio of, ranges between about 8 to 10, maybe 10 to 12 stocks, and then he has a portfolio of ETFs in there too, like 5 or 6 global ETFs, and he's done quite well. Again, go to cabotwealth.com/street to get a 70% or an offer of 70% off the normal price for today's listeners. Okay, let's get.
Before we move on, do you want to touch on China real quick? Like
Yeah, I love BYD. Beyond that, it's a toss up.
toss up. Yeah, the because Hang Seng up 23% year to date, right? I think the thing to be aware of with China is that it is subject to a lot of false starts where you get,
Yeah.
we saw it a couple months ago where you get stimulus news and then people sell the rally. You get sort of untrustworthy data from central authorities. Um, it's a tough market to play in. I do think that if you are looking at clear winners, there's probably a lot of opportunity there. Um, they're doing exceptionally well. It's become the China story of just like I don't know how much I can trust them.
Yeah.
So given the uncertainty in the market, I think maybe you pick some clear winners there or names that you really love, like BYD.
Yeah,
I was
the big names. Think I saw maybe one of our analysts high on maybe not recommending, but having Alibaba on his watch list recently. BYD is the name. I've been hammering that name for more than a year on this podcast, and we're really seeing it basically come into its own recently. I'm sure strength in the Chinese market has helped, but also
the
it's putting into practice its um, its global expansion plans, going from 90% of its business being in China to now they have plants being developed or already developed in Southeast Asia, in South America, and Europe. They're not in the U.S. yet, but maybe eventually. Right now, I think you could argue that's a good thing because all the tariffs. But then they're also rolling out self-driving technology. They're also struck a deal with DeepSeek for AI. DeepSeek's the hottest name in AI right now, Chinese AI company. And they really have their foot on the gas pedal for no pun intended, but
They
yeah,
they
I'm happy.
also they also just announced a 5 minute battery
Yes, yeah,
fast charge. It's like 5 minutes to get 600 kilometers, I think, or 400
it's
kilometers. I don't
400
remember.
kilometers in 5 minutes.
That's
Yeah, close to 300 miles.
that's like a game changer. Like seeing that made
Yeah,
me think, like, I wonder if I could get a BYD car.
yeah.
Like I got my Wrangler lease expires in like a year and a half. I
I
wonder
don't
if I
think
can
you
get a
can right now. Can Oh, a charger. Yeah, charger you can. Maybe.
Oh,
Can
no,
you?
you could probably buy one in China and then like pay to import it the way that people buy like the Japanese K trucks, I think they're
Yeah.
called, the little mini trucks. There's probably some exemption way where it doubles the cost of it, but
Yeah, there might be a tariff involved there.
seeing the developments there, like they are doing what Tesla should have been doing and has sort of promised to do, where it's like, hey, no, we're gonna do the best that we can on all this stuff, and instead of over promising, we're like, hey, we'd love to hit 1,000 mile range, but it's not practical. So, how about 5 minute charging to go 400 kilometers? We would love full self drive, not really feasible. Here's this God's eye view that's gonna uh, offer like the best version of drive assist that we can.
Yeah.
So I don't know. That
They
is
in the
an
last month or so are doing the things that Elon Musk has been promising but hasn't
yeah.
done for years, while he's busy, firing everyone. But okay, let's get on to one other asset class that's not the outperformance isn't as strong as Europe, but value stocks have outperformed growth stocks this year by a pretty wide margin. They're up U.S. value stocks up 1.5% this year. Um, at a time when growth stocks, I'll have to pull up. I think you have some numbers, right? You have some numbers.
Yeah, mine
Yeah.
breakout by market cap. Large cap value up 3.5% this year. Mid cap value up 1.1. Small cap value actually down 3.1%, but that's compared to small caps as an asset class being down like 10%,
Hmm.
or 7%. I don't remember what the statistic was. We said it earlier. You can hit rewind on the podcast. Large cap growth by compare or for comparison down 8.3%. Mid cap growth down 3.3%. Small cap growth down 6.1. That is an 8.5% spread on average between, so per 8.5 percentage point spread between the performance of growth and value stocks on a per market cap basis. That is a very big disparity. So even seeing, value as an asset class only up like 1.1% in a sort of generally weak market, um, I think that I don't think that gives you the full picture. It's value has become much more popular.
Yeah, and this is something we haven't seen much of the last, 10 to 15 years, value outperforming growth. Um, which over time, value does outperform growth over, at least over the last 100 years or whatever of market history. Is this a permanent shift back to, not permanent, uh, longer than a few months shift back to value? I think if I were to bet, I would say that value would outperform growth this year at least. Beyond that, who knows? Just because of all the uncertainties out there. Um, and because, there was such a disparity for years. Um, are we going to see value stocks up 20% this year? Maybe not. Probably not. But as you mentioned, like I think you just mentioned that value stocks aren't even as undervalued as they have been at times. Despite the underperformance.
Yeah, so it that is, a good transition. From 2006 to 2015, the S&P value was trading with a PE of between 10 and 15. Um, Forward PE of between 10 and 15. It was sub 16 between sorry, 2015, and then when COVID hit. Right now it's at 17.2. So value stocks are actually overvalued on a historical basis. Um, for comparison, the forward PE of the S&P 500 is 24.4. So they are still trading at a discount to growth stocks, but both are seeing inflated metrics there. The it becomes a challenge because if you are trying to buy value stocks and they're fundamentally overvalued, it's tough to sort of make a value case for it. But I do think that it is they are a maybe a safer and potentially more popular place to be. From January of 22 to October of 2022, the S&P value lost 15%. So that was during the bear market that saw some of the growth stocks, especially tech stocks, really take a hit. I think, we had 22, 23% declines for the broader market. So they are going to be a buffer for you, but I don't think that this is like the opportunity that Europe is. Europe
No,
is
no.
going to be making up for decades of underperformance. Value has been drawn up by that rising tide and
Yeah.
has gotten excessively valued. So this isn't like a pile your entire portfolio into value because there's this once in a generation opportunity, which I think is actually kind of the case for Europe. I
Yeah.
mean, that's overselling it a little bit,
Europe is
but
the value play.
yeah,
You know.
yeah,
Yeah.
domestic value stuff has been inflated with the same money that's been inflating growth. Um, the real value play is probably overseas. But I do think that if you're maybe concerned, if you want to maintain equity exposure but are concerned about growth, I think you can overweight the value a little bit, um, because you're going to weather the storm. If this turns into a bear market or if the correction gets worse, you're going to weather the storm better. But I don't think you have that outperformance potential that you're going to have elsewhere.
Clip this out for their year-end hot sauce episode, Madison. Hopefully, I won't need to. We don't need to bring it back, or at least not in a bad way. Value stocks will be up, measured by the VTV. It's a good measuring stick for value. Will be up 11% this year. The S&P will be up 8%. That's my prediction.
So VTV right now down 1% year to date.
I think it's up one
S&P.
and a half percent. No, was it not?
Oh, sorry, that
Maybe that flipped
was
today.
yes, no, up 1.5%.
Yeah.
That was bad responsiveness from Google. Yeah, up 1.6% year to date. So you figure they got another 10% to run. That puts VTV at right around 190 a share. So we'll mark that. Uh,
I think value, the real leaders of the next up leg in the market. Well, value will lead the US market up, but it will compare the US market will pale a comparison to the European market this year. I guess that's my take. European stocks, value stocks, growth stocks will be the pecking order for the rest of the year.
I think that's a good call. Even if everything goes down, I think your pecking order stays the same. I think
Yeah,
Europe
right.
outperforms value outperforms growth, sort of regardless of market conditions, unless we get like AGI, artificial general intelligence, where it's like as smart as a person, like all the thing, like the over promising that these some of these tech companies do, right? Like there's this sort of white swanny event that causes drastic outperformance. But I think in anything that's even reflecting normal market conditions, you're right.
Yeah. Okay. I think that's a podcast. It's probably
Yeah,
about time to get out of
too
here.
much of a podcast.
Yeah, we've covered it all. We've said it all. I think this Howard Stern usually says when he's sick of his guest. We said it all. We'll see you back here next week. Hopefully the market continues to improve or not go down. And thanks for joining the latest Street Check.